I'll just have to upload it to YouTube afterwards, and then on Friday, figure out how to get it to YouTube while I'm streaming. That'll solve that problem. So let's talk about the idea of buying the shares. I mean, I really like this butterfly. I'm probably gonna put that one on myself. Um, but buying the shares offers you a chance to run some defense, and that's always really good, right? There's absolutely nothing wrong with being able to defend a trade, and that's what makes options so great to start with, right? That's what they were designed for, really. So let's kind of put that into perspective. One, can you trade 100 shares? Because if you can't trade at least 100 shares, then bringing shares into the equation loses some of its glimmer, right? But if you can buy 100 shares, you can defend this trade with a put. The idea behind that is if you own 100 shares, you can buy a put, and the put gives you a right to make somebody else buy your shares at the strike price of your put. That's why it was named a put way back in the days, because you would be putting the stock on somebody, whether they like it or not. Right. So, say you bought the stock at $78 and you buy a put for $80. Well, that means you get to guaranteed sell your stock for $80 a share, and that's $2 profit per share. Sounds good, right? You bought it for 78 and you forced someone to buy it from you at 80. But if the stock goes to 85, you wouldn't want to make somebody buy it at 80, right? You'd rather just hang on to the stock and sell it yourself on the open market for 85. So if you use stock and the stock falls and you've got that put, you're good. Doesn't matter how far we fall, you'll always be able to sell it for $80. But if you buy the stock and you buy a put and we just break up and just keep on going, then you close the put, take a small loss from the put that you bought, and the stock makes up the difference and you still get profit from the stock. A lot of traders trade that way. They trade the stock and they protect their stock position with puts. And some people straight buy the put every single time, every single trade. And then others, they just buy the put if they think they need it. They don't buy it every time. It's not a bad way to go, really. Um, I've noticed people go to extremes sometimes. For those people that do it every single time, they've been burned, and then they kind of overcompensate and say, I'm never going to get burned like that again, I'm always going to use the put. And then of course they don't always need it, but they do it anyways. So I don't know, it's not a perfect world. So yeah, buying the stock isn't a bad way to go. Plus, since you can control your loss relatively well with having shares. If you don't have the ability to buy 100 shares, then you can still feather into the position, say, 15 shares here, 15 shares there, until you finally get to the position size that you want. And as long as it continues to prove that you're right, say you get in today with 25 shares and it breaks through 80, and then you put in another 25, and then it gets through the break even, and you put in another 50, right? And as long as it's proving you right, you just stay in and keep adding to the position, letting it grow. So yeah, I can't ever argue against having a stock position. I mean, there's some stocks that are crazy price, couple of $1,000, and of course, then I would say, no, nah, leave the shares alone. It just isn't worth it. But for Hood, less than 100, it's not bad. I did like that butterfly though. The 85 strike butterfly, $3 wide. Right now it's running at about $22. And that gives you a window between 82 and 88. As long as price lands somewhere in that window, you'll see some form of profit. And the risk is only 25 bucks. So you could get a number of those. Huh, that didn't. There we go. You could put on, you know, more than one, spread them out into different places. That's the window that we would need price to close in for the butterfly to be profitable. That area right there. Up to a max profit of 275. Not bad for risking $25. And of course, you can roll or adjust as well. So, um, say it overshoots and goes to 90 or 98 or something like that, you can roll the call side up. So, you can kind of chase after it and try to get some profit locked in. The puts would be toast, but not the calls. I shared an image the other day of some of the companies connected to NVIDIA. And with NVIDIA going to report today, it's worth considering what's going to happen to some of those companies. These are NVIDIA data center companies. Oh, and did you guys see NVIDIA's 13F filing? It has taken a stake in a number of companies. Those companies would probably be worth looking through as well. But these companies do business with NVIDIA or are a part of the NVIDIA data centers build out. Some of them are in direct competition. Um, they came from a news article. So let me find the image that I shared in the chat with you guys. And that's where I found them. I shared this in the chat the other day. I'll put it in the chat again now so you guys can see it. Tech giants AI capex surges. Which data center suppliers will become big winners? And so this is where I got that list, right? Now, what I did is I went to AI and I started asking about every one of these companies in connection to NVIDIA, right? So that I would have a better idea. Hey, what do these guys do? Now it shows APH and then data and power connectors. But I mean, I didn't quite know what that meant. So I just went to AI and asked it some questions. Then I went to the next one and the next one and the next one. And you know what I mean? Because I wanted to understand this better, what their role was, what they're doing. And some of these you can see they're like ANET deals with Meta and Microsoft a lot more. And CLS with Amazon, Google, Meta. So yeah, it was kind of a big deal. I went through the list, talking to AI, trying to understand where the risk is. I got to admit, I was surprised that APH has such a large moat around it. Its peers do not threaten it at all. There is nobody in the space that they're in with their level of output. They just stand out all by themselves. The problem is, look at their chart. they're so wound up to the upside that, it's like, well, I don't want them now, that's been one heck of a run. And now we're broadening out and it's getting ugly. So I really like the company APH right now, but no way I'm trading this thing long or short. Exactly, right? So this one is definitely on my radar and I really like the company, but not here. Right? You know what I mean? If we come back down though, I'm definitely going to try to get in around that 120, 130 area. I will be really excited for an opportunity to get in down here, but not up here. And then look at this one, CIEN. And almost all of these had very bad options. They they're almost all either stock trades or you're going to have to run like poor man covered calls and poor man covered puts, that sort of thing. And that's my trick when I come across bad options, but I still want to trade, you know, like you have to have a solution. So for a stock like this, where I would still want to use options in the trade, that's the best I can come up with is like a poor man covered call. And I don't like it. It's just, you know, it's either that or sit out. CLS is another one. So, hey, let's go back to this one for a minute. CLS, what's it say on that page? Amazon, Google, and Meta. Okay, that's not a NVIDIA one, anyone. Anyways, COHR, that's a NVIDIA one. If we was to get a bad earnings and NVIDIA goes down, it's likely that these guys are going to get whacked and they're going to go down. So if you wanted to trade NVIDIA earnings, but you don't like the cost of NVIDIA's options, this is a good alternative. And if we look at the top 10 names in the IGV, oh, it was CR. I was about to say maybe it's in that top 10, but it's not. It's crowd, not core. Never mind. Still, these guys could get hit. Or FN, that's another NVIDIA player. Optical transceivers. Boy, this thing just so expensive. That is so ready for a reversal. But there's no good way to play FN. That doesn't even have monthly options. Broken trash. I'm looking for something. What we got here? I'm certainly not in a NVIDIA trade right now. there's too much risk, right? Trading into an earnings announcement is like going to Vegas without the free drinks. You might as well just save your money, right? You want to trade into the event, which would have been back here on that gap up, or you want to trade after the event. Well, maybe 10 is too much, right? Let's dial that back to 5. That way we just get the AI stuff. So this is what we know about Nvidia and its earnings. In the last 20 quarters, it has beat 18 times, it missed 2. In the 21-day pre-earnings run, they make an average move of almost 9%. That's why I mentioned getting in before earnings to take advantage of that run up to the earnings date. The average 21-day run into earnings makes a 9% move. That's $17. That's not bad. After the report, there's that 8-day window on the other side of earnings, and it has an average move of $6, which is around 3%. Again, that's not bad either. If we look at moves that were bigger than 5% that lasted up to the 5 days after the report, 9 out of 20, well, 9 out of 18, really, because we had 18 positive earnings. So 50% of the time, we had a move greater than 5% that lasted after the 8-day window or up to the 8-day window. That's a 50-50 chance of getting a move greater than 50%, or greater than 5%, excuse me, not 50%. A move greater than 5%. Now, it had 2 misses, but it's had 9 negative days or 9 negative moves after earnings, even though it's only missed twice. So, when you think about it, that's almost a 50% chance that it's going to go down no matter what it does today. Well, that's not good odds, right? That it can report good earnings, it can beat and still go down. And the down move can be greater than 5%. That's not good at all. Which really highlights why you would not want to be in NVIDIA when it reported earnings, long or short. But these stats are really useful if you wanted to do like those earnings iron condors. Because a lot of companies, they report and within 8 days, you look back and they're still within this 5% window. And that's great because then you can put on an earnings iron condor and watch it gyrate on the report and make a big move and then come right back down into the window and you get paid. But not this name, right? This name has a history of making big moves and keeping those big moves. So you don't want to trade earnings on this unless you're getting some lotto trade to take advantage of that big move. But because it's NVIDIA and its earnings, those options are going to be so expensive that you wouldn't be able to get a cheap lotto, right? That's a catch 22. here's some cheap options, but they're so far out of the money that there's a snowball's chance in hell that they'll even print anything. And so that's a bad idea too. Uh it might be possible. I don't think I don't think so though. Not the way Thinkorswim works. At least not with this chart. You'd have to approach that from some other direction. Now there's companies like Earnings Whisperer and Whisper Number that will give you an opportunity to run that sort of a scan, but those companies aren't free, right? But like I've always argued, if you're going to trade earnings a lot, then you want to get one of those earnings tools. They're absolutely worth it. I don't like to trade earnings. So to me, I don't need one of those tools. The only earnings I like to trade is the ramp up into them and or after they report, trading away from them. And that doesn't require a service at all because all you got to do is just keep track of earnings. You know, like Nvidia is going to report today, obviously. And by tomorrow, we'll all know if it's good or if it's bad, and we'll be able to trade out of it long or short, right? Like we don't need a subscription for that. And for the Iron Condor that I mentioned, you need to see what the stats are when you come into the earnings. So we don't want to run a scan per se. We want to evaluate the company that we want to trade and just ask the question, how does this company do with earnings? Here's that earnings chart, by the way. I'll just put it in the chat. All right, ABT is done with its earnings. And we've got this island that it built down here. Can't see it on a weekly, but you can see it on the daily. The gap close is way up here. And we've already breached above this candle and we was able to keep it. When we popped above it that first day, the threat was that we was going to fall back down, but we buzzbeat off of it. And now we're holding. So we've got the potential now to close this gap. Let's see what ABT's earning options look like. And dollar wide, 30-cent bid ask. We got a $5 expected move. Oh, not very liquid though in the options space. That's the range that we're working with. We're not to the midpoint of this monthly bar yet, but we're hitting the midpoint of this range here.
Seems like a lot of stocks I want to get into are have the bid ask is not viable.
Yeah, that's it's been like that for a while, and people say, how come you're not trading more? Like, because everything I look at has really horrible options right now. And my rules tell me to leave them alone and not trade them. These high-low graphs are built on the CBOE list that we downloaded a couple of weeks back. And even these are the most heavily traded stocks of January 2026, the most heavily traded options. And they're not bad. I mean, but they're not, I don't want to trade GameStop. I don't want to trade um, Roblox, but they're the ones that do have some liquidity. And it's got, Citibank, Capital One, Microsoft. It's not bad, but Altria, whatever, however you say it, I don't want to trade these guys. Look at that trash. But I mean, can't argue. We're getting that breakout. It's been a good 2 months for these guys. Look at that. So I agree with you. The stuff that I want to trade is so illiquid that when I look at it, I just refuse to trade it. So follow the liquidity or break your rules. I refuse to break my rules. They are in place for a reason. I've learned my lesson over the years. I do not compromise. It's a lesson, right? It is definitely a lesson that you learn the hard way. So let's look at the names that are up and the names that are down. These are liquid-ish. They're the best ones on the scan list, and they're breaking out and making moves like Applied Materials. That looks wild, doesn't it? Doesn't even have another earnings on here. There it is. Whew, all the way over to May. All right, it's a long ways off. Um, but I mean, look at that. Let's see if we've hit 50% of the measure. Okay, yeah, we overshot 50. We're headed to 100% of the move. That would be $400. Well, let's see what we can get for $400 for March. $2. Risking 3 to make 2. We don't have much open interest on the 405. Take it to the 410, almost 50% credit. I don't mind that at all. 50% credit that far out of the money. Not bad. The break even would be probably 404.75, something like that. Let's see. 404.75. So the stock would need to close underneath 404.75, which means we can hit this 200 level, overshoot it, and we'd still be good. That's not a bad trade right there. Not bad at all. That's Applied Materials. It is going against the trend because obviously the trend is bullish. And the threat is that it paused already these 2 weeks and that the pause was all that it needed to digest. And now it's starting a whole new breakout and it's going to actually take a whole other run. That's the threat. But I don't know, I kind of like that. I like that butterfly that we looked at, and I like this. Because remember, it's not about not losing. That's that's impossible. Let's get logged in here. The Fidelity, are you on the app or are you on the website? Because the app, I haven't used the app in so long, I can't even remember how to do it to walk you through it. But on the website, you should have a butterfly button that allows you to just choose a butterfly. Otherwise, when you go to build it, you can just build it leg by leg, right? So say I'm going to save this so I don't lose it. We'll just throw it into the analyzer. And now we'll go back to Hood. Say you wanted to build this over in Fidelity on their website. You would choose the long call first. So just, buy the 82 call, but then it'll have the plus sign to add another leg. And then you could add the 88 call and then hit the plus sign again for another leg and then add the 85 shorts, right? You can do them in order. You can do 82, 85, 88, but you got to just keep hitting that plus sign. Let me get logged in. I can't remember. I have never traded on the mobile at all, ever, but I know you can. I peek at my positions with the mobile. Yes, send me a notification for goodness sake. Prove that you're you. I mean, on the one hand, these two-factor authentications are annoying and frustrating, but on the other hand, they do stop us from getting hacked. So, all right, I'm in. All right, so trade. We want to open this up.
Actually found it under option strategy. You can scroll and I found butterfly.
Cool, cool. Good to hear. Yeah, I knew it was possible. With my Fidelity, I mostly just do stocks, but I have done a
Mhm.
little bit of options. All right, AMAT. we're looking at this short call vertical or bear call spread, if we want to say it that way. The break even is over our head, so we don't need price to do anything. All we got to do is stay where we are or fall down. Price could continue to go higher up to 404.63, and we'd still be good. We are risking 528 for a chance to make 472, but that is suggesting that we won't manage the trade if it begins to lose, because we don't need to lose the whole 528, right? That would only happen if you put it on and never look at it again. And who would do that, right? Of course we would manage the trade if it isn't working. We would close it down and take a smaller loss. So worst case scenario, 528. But on the other side of that, we very likely won't take max profit. I don't like to stay in all the way to expiration. I don't want max profit. I just want some of the profit. Your risk of losing goes up significantly if you try to hold on for the whole bite. You're better off aiming for percentages. So some platforms will do this math for you. Some you have to do it yourself. If you're doing it yourself, just take all of your credit. In this case, it's 472, and then divide it by 4. So 25% is 118. You would subtract 118 from 472, and that'd be what your close price is. You would have put in your exit order at 354. Now, me personally, when I'm doing this and I look at something like that, I don't care about the 4 pennies. I put my exit in at a round number at 350. And then, of course, if it needs to be adjusted, then I'll adjust it. So that's taking profit at 25%. If you have 4, 5, 6, 7, 10 of these, then you can fade them out. I like to use quarters, but you can fade them out at different percentages. Take some at 30%, take some at 50%. Just the idea is anything above 50%, you're getting into holding for too long, and then your risk really goes up. So when you get down to like 75, 80%, you want to be mostly out of the trade. If you started with 10, probably don't want more than 2 or 3 at that point. Really fade the position out when you get closer to expiration or closer to max profit. So this is not a bad trade at all, other than it's a little big, $10 wide, and that's really the worst of it. March expiration, so it's not that far away, and we would not have to hold all the way to March. We are dealing with the trade before any real earnings, because earnings isn't till May, so we won't have any earnings impact whatsoever. The other big risk here is that this is an excited market. It's obviously getting a solid push to the upside, and trying to stand in front of that is trying to stand in front of a bulldozer. So, there is risk to this sort of position. I tried this with NVIDIA, believe it or not, way back in the day when NVIDIA got bullish and had made a really big move. I tried to put a call vertical on top of it. That did not work. I got run right the hell over. So, messing with bullish markets, they can travel farther than you think they can. But I like this position. Let's try to work the order on this and see what we can get. March 20, we had the 400, 410, and I'm showing $465 in credit for that. I'm going to try to work the order a little. I'll set it at 75, see how easy that feels. The idea behind it is we don't know. We can see the volume. It's only a couple hundred. And I don't have last showing, so we don't know what the last price was for each of these trades, but there's a really wide bid ask spread. I mean, it's really wide. So when you go to build this order, you don't want to pay whatever it shows down here just all willy nilly. Try to haggle and negotiate and get a fairer price. I've got an order working right now for 475, and after I submitted it, I can see the price has dropped to 450. I'm not going to move my order yet. I'll work the order in a little bit, see if I can get a different price. But always try to get a better price, right? It's kind of the idea behind it. Yeah, what did we get? What did we build here? All right. Right now it's trading for $21. This one is opposite of what we were just doing. We were trying to sell that, and I wanted to put higher numbers in. You're buying this, you want to put lower numbers in. So this says we could buy it for $21. You would want to adjust that and try to get it for cheaper, something like $19 or $15. It's 82, 85, 88. Let me bring the broker up. $82, 85, 88. We've got 2 short and 1 long on each side. And my broker right now is showing 17 cents. If I'm buying it, I want to buy it cheaper. So I'll start with something like 15 cents and see if that fills. The strike width, I'm using a $3 wide, so you could put 3. If you don't like this risk, this is trading for $26 or $15. But if you're looking at that and you're thinking, no, it's too much money, I don't want to risk that, then make the width smaller. If you look at that and you think, wow, that's really cheap, I'm willing to risk more than that, then make the width bigger, right? The wider the width, the more money it's going to cost you. These are pretty cheap. I would probably be willing to make it a little bit bigger, especially since there's more liquidity. We can see it right here at the 80 and at the 90. So if we had gone $5 wide, probably would fill at a better price. I'm going to cancel that order and see what it is going to cost for a $5 wide. $70 basically. Let's see if we can get that a little cheaper. Now we could have got 3 of the others for the cost of just this one. So if you don't want to make it bigger, I understand completely.
Yeah, so what's the next step? So I put 5 for the strike width, but I don't know what to do next.
Look at the screen and see what it's offering you. Somewhere on there, it should say something like, what is the start? What do you want to do? Calls, puts, right? Like if you read the screen, it should have the pieces that you're looking for. It should tell you
Yeah,
what
so I have both. Both. I have both, and I don't know which one to start with.
you want calls.
So the cause, it's 85. We said 85. Buy. Okay, I found it.
You want to sell the 85.
Oh. Yes, sell the 85. Yes.
And you want to sell 2 of them.
Mm,
And after you get 285 short, then you want to add the long calls.
okay.
So on the screen, I've got hood, options, action. We want to put on a trade. Now I'm not building it where I'm telling it that I want a butterfly. Just I've got call here. What do I want to do? I want to sell to open 2
Mhm.
at whatever I want. So
It's March 20th.
March 20, and I'm gonna sell the 85. So just like that, I've got 2 calls, sell to open at the 85 strike, and now I can add a leg right there, and I can choose to buy to open 1 call March 20, choose the strike with. We started with a $3 wide butterfly and it was around 20 cents. So if I want to make it $3 wide, then I can just count up from 85, which would be 88,
88. Mm-hmm.
add a leg, buy to open, 1 call, March, and I want to go down from 85. I want to go down 3. So that'd be 82. Now we've got a butterfly.
Perfect.
Sell the body, buy the wings, $3 wide. The trade is running with a midpoint of 25 cents. If we was just blindly pushing buttons, we could fill for 57 cents and that would be really bad, but that's what traders do. I see it all the time. They don't think to fight. They just pay what it says, and it says that this is $57, but we don't want to pay that. So the midpoint is 25. We want to try to get filled for that or even cheaper than that. So we can put in an order. Fidelity won't let us go too cheap. So I'm surprised somebody's getting away with this $7 bid, but we can try the midpoint and see if that fills, or we can take the midpoint and knock a couple pennies off of it and see if that fills. But I've seen it give me an error if I make that too low. Like I might make it 15 cents and I hit preview order and then it pops up with some error like that, just like that.
Yeah.
Well, that's one. Actually, what's wrong with this?
You don't have enough money.
Yeah, I don't have enough money. Huh. So usually if you make the bid too low, then it'll pop up with some kind of error. Fidelity now has some restriction against spreads. You have to have a certain amount of money in there before you can trade them.
Mhm.
I don't usually use this account for options. And when I did, I was running covered calls. So it's different trade.
Did you see the maximum gain?
I already know the maximum gain because it's just math. If I buy it for 25 cents, then the max gain is 275 because it's a $3 wide spread.
Yeah, 285.
Yeah, that's math, right?
Thank you so much.
Absolutely. The spreads that we build, for the most part, are they're completely math centric, right? They can't lose more than the trade itself, what we spend to get in. And since the whole thing forms the size of the trade, then we already know what our max profit and our max loss is. In this situation, I'm going to just move this down to 25 cents. $3 wide minus $25 is $2.75. That's why we know what our max profit is. We can always do that, right, for these kind of trades. And that way we don't have to sit there and wonder later, what was my max loss? What's my max profit? This is important because the bid-ask spread can get really wide and your risk might show $70, $90, $120, and that's going to freak you out because you're not supposed to be able to lose more than $25. So if you're new to options and you see your loss going way beyond what you're supposed to be able to lose in that trade, don't freak out. It's because of this right here. This is the bid ask spread between the bid and the ask. And it's not really big at the moment. It's just 10 cents. But anybody can put a number in, right? So if I owned an 85 call, I could try to sell it and I could put $3 at that number right there. And if I did that, they would show $3 right there. That would really make the bid ask wide. Now, of course, I wouldn't get anybody to buy my call for $3, but it would still mess the skew up. And for the person who's holding those calls, they would see that price get all jacked up. So if your trade is losing, remember that it can't lose more than the money you spent. So if it does fill for 25 or 27, 23, whatever it is, that is your max loss. No matter how bad it gets, it won't lose more than that. And it can be scary because I've seen trades that can't lose more than 10 cents show $500 of loss. And that's a big difference between $10 and $500. But of course it won't fill at a $500 loss and you really can't lose 500, but it'll show it. All right, so we had Capital One with this this is a really good example of a double bottom. Now, I've always argued when it comes to double bottoms that I want price to go lower than the previous low because a double bottom is a bear trap and you're not trapping any animal if they don't actually get into the trap. So if price comes down and it bounces off the line and it goes the other direction, well, they never got into the trap. We need to get them in there. Capital One broke that previous low, dipped down into a 1, 2, 3, 6, and has begun to rally. And we want to examine what the rally looks like. Because if we did trap some bears and we're squeezing their heads to make them pop, their buying adds to the buying, and we get these big explosive moves back in the other direction. But I'm looking at this and I'm not seeing some big explosive move back in the other direction, at least not as explosive as the move down. And this big red bar looks like a liquidity bar. Now I'm kind of worried that we're going to come up and close that liquidity gap and we're going to go right back down again. The financials haven't been doing all that good. If we zoom out and look at this road trip from January, it's been been getting a bit of a beat down. So if we think that Capital One is a short, today's the day to do it. It's been up for 2 days straight. We are closing near the high of the day, and we're closing really close to the previous, that big red bar is open, which would be where the liquidity gap started. If you want puts, you won't get them cheaper than a situation like this, where we've already been going up and nobody wants the puts, and it's the better time to do it. But I'm looking at these puts and they're still really expensive. $2.50 wide, that's not bad. 30 cents on the bid ask spread, it's not great. If I was running a long put vertical, $2.50 for 40 cents, we're risking 40 to make 210. Not bad. 40 cents isn't that much risk. We could probably get it cheaper with a butterfly, somewhere like a 200 strike butterfly. But with 3 minutes left in the day, I don't think that butterfly would fill. For that one that you built on Fidelity, being this late in the day, you might not get filled today either. It would still be a good one to try to trade tomorrow, all things considered. Take a look at Hood real quick and discuss that. So if you don't fill today and tomorrow Hood falls down lower than today's low, don't even bother putting that butterfly on. But if you do fill today, then, don't worry about it. It's all good. Just, it's late in the day, and 3-leg trades like a butterfly are hard to fill when we're haggling for price, and it just might not fill. So watch how Hood opens tomorrow, and if it gets underneath today's low, then just don't load it, right? Don't bother putting the trade on. I don't think we're going to get that sort of a move down, but really it just comes down to what earnings looks like. Nvidia has such an umbrella. I can't find my list. Let's just talk to AI and get a new list. See where my button is. There we go. Intel, SNPS, CoreWeave, Nokia, and Nebulous Group. And the top two names make up 80% of its total 13F filing. So these are companies that NVIDIA has invested in. Let's take a look at CoreWeave, or Cisco, my bad, Cisco. I got CoreWeave on the mind. Yeah, what a beatdown, huh? So same thing, we got that island here, and you got that big event bar. Now, in a situation like this, you can measure the bar because it is the boss, or you can measure the whole thing. And if you do both, then you get this really nice little channel down here. And I kind of like the channel. So I'm going to put the channel on there. And then I'll just delete this lower leg. So this bar is the boss. We got a GTFO, right? And then inside of that bar, we've got this bar. So on the one hand, we're above this mid and we're above this mid. So I like both of those, but 79.5 has been drama. I should have made that a little bigger. Really, 79, isn't it? We closed above once. We wasn't able to keep it. The very next day, we gapped down hard. Right? We closed here and we opened down here. Then it ran a loop to loop, ended up closing down here. So it didn't like getting above 79. So rejection, rejection, rejection. This didn't even get close. And now here we are today. So if you like Cisco, you want to really watch tomorrow morning how it opens. Because if you get another one of those red bars with this big drop beat down, see how it rallied up and then it dropped? Are you in this? Because if you are, watch for this sort of behavior tomorrow. It will help get you out, right? So if we open tomorrow, um, look for that loop-de-loop, and that can maybe help get you out. If you're looking to get long, you got all this resistance at 79, and then you got everything in this wick. And to me, that's the drama. That's the trouble. $80 is going to be a really big deal. Plus that old market phrase, if 80, then 100. I know it sounds silly, but I've seen it so many times. So getting back above 80 is going to be big drama. But once we do, this will be a nice work back to 90. And then, we can work our way up to 100. I don't like that it wasn't able to get above 90 and that it didn't get above 100. But, it's a work in progress. So we got to get back above 80 and we got to get out of this monster bar here. Yeah, closing that gap would be awesome. But in these island plays, if they gap down and they can't get out of that mother bar, it's toast. What would be cool is if it spends a little bit of time down here, say the whole quarter. I know that that's not exciting for a long trade, but hear me out. If it sits down here for the whole quarter and it heals and they don't do anything stupid like issue stock or get caught embezzling or, all the stupid stuff we see every day. If they don't do anything stupid to break it, they spend the whole quarter down here basing. Then after the next earnings, we make that move back up, get the gap closed, break new highs, and make that run towards 100. I'm concerned about this. We had that earnings and we stayed in a range, and then we finally went down and closed it. Then we turned things around and went the other way. So on the one hand, that does imply that we'll go up and get that gap closed, but not that we keep it. And that takes my 100 off the table. It's very likely going to be up, down, 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 up, down, up, down. It's rare for an earnings to come out and it just gets the initial move the whole way, right? So the down part, don't let it freak you out. That's just an opening salvo, as they say. Axion selling 5 million shares of common stock. Glad I wasn't in that. Get out the way. It's gapping up when they're diluting stock. Well, it gapped up on their earnings last night, and then it held that gap today. But if they're going to dilute the stock this afternoon, I expect it's going to go down. When did they dilute? Yeah, I would expect when the news comes out on that, because I'm not seeing it on Thinkorswim yet. It's just in the latest here. And it came out, where was that? Right here at 406. So it just came out. That's going to very likely cause the stock to go down, but it's not guaranteed. And when you see it go up, if they dilute and it does go up, that's going to be very bullish. Yeah. All right. So NVIDIA, it's gyrating. It's going to move around. All of those AI plays are crazy expensive, and the options are just horrible. I think that's a part of the reason that we had that capital rotation into other stuff like Pepsi and chocolate, Hershey's, Campbell's soup, Altria, because one, it's really crowded, and two, it's really expensive to try to play those AI trades. And retail that doesn't know what they're doing is getting slaughtered in there, just murdered. Better off playing the liquid stuff, even if the liquid stuff is things like, airlines and yeah. So Capital One didn't look bad, Let's see what City's got. City's junk. It's in the middle of nowhere. DraftKings, that's a beat down. Intel. What I had going on here. Scribbles. ISRG. There's your textbook flag. You couldn't draw one better than that, really. Look at that, huh? That is a textbook flag right out of the, I mean, just, mm-mm. Oh yeah. All of these, right? Meta, ISRG, Adobe. Talk about some trash options. But these are the names that were the most heavily traded in January, the most heavily traded options names. But the volatility is so high that it's jacking the options out of control. That's why, remember we were talking about the weekly expected move, and they're actually pricing in my iron condors as being enough, but it's not. It's because we're in such a high volatility condition that we're actually seeing profit in there. But the win rate is broken, the range is extreme, and just because the quote just because the price is right doesn't mean we should be trading them. These options prices are so out of control because the volatility is jacked up so high. Now, Target, Costco, BJ's, Walmart, they don't have the liquidity, but I mean, even that ain't good. Look at 50 cents wide, 60 cents wide. Nasty. There is nothing wrong with just leaning against the ETFs and staying out of all of this mess, right? The XLs, uh, XLI, XLF, XLY, XLU. They're not, fantastic things to trade, but the volatility is less. And in something like the financials, XLF, this one's always been a good one to trade. Yeah. That and the SPY and the Qs, which is why a lot of people, it's hard to argue against just buying SPY and not trading. That's what I have my sister-in-law doing. She's just long SPY because she's not a trader, but she wants to be involved in the market. She didn't want to learn all of the stuff that comes with it. So it's like just buy this. Just buy SPY and take a year or two and so but she's not a trader, she doesn't want to learn to be a trader. She just wanted to get in the market. Yeah, I mean you can't go wrong. That's why I don't understand why money managers are able to collect so much money from people and then they can't even benchmark and beat the SPY. You know, it's like, what are you doing charging me all this money, managing my money, and you can't even beat SPY? That's sad. Same thing with all those retirement accounts. You know, people go to work, put money in their 401k. And if you look at what the 401k is holding, they're in really safe stuff like Apple bonds and Facebook bonds and things like that. It's like, really? You're making 3% with my money? You could be at least making SPY. Oh, yeah. You know, the sad thing is, most of the money that I see in retirement accounts, I talk to people who don't trade and they're like, yeah, my retirement account it's growing. I'm like, well, yeah, because you're contributing to it every paycheck. That's the only reason it went up is because you put money in it. You quit putting money in it, and you're only going to get 3% from the Apple bonds that they're invested in. What a scam. And they charge people for that. Well, the market was waiting on this, and I think the market gave us a little bit of a tell because of this grind up that we had today. And you know, I wasn't sure we were gonna get a grind, but I suspected. That's why I talked about it quite a bit in the morning briefing this morning. That I really saw it was possible. And I can't see why we would get this grind unless the market had some idea about what Nvidia was going to say today. And I'm sure they do, you know, between AI and the resources that these big funds have, they probably know exactly what NVIDIA is going to say. The only outlier is their forward guidance because they keep that number close to the vest until it's time to report. But as for how they did, I'm pretty sure the market knows exactly how NVIDIA did. And this slow grind probably was an indication of what we're going to get. A non-negative earnings. That doesn't necessarily mean positive, just not negative. If we do make it through today without the market crashing, we should see a good continuation into the end of the week and maybe into OPEX for March. We have there's still something coming, and I can't remember what it is. But between now and OPEX in March, there's something else really big, and it's not China, because we do have China starting in 2 days, but it's not that. It's something else. But I think we can get SPY to 700 or ES into 7,000. I see that if this earnings doesn't wipe us out. And with the grind we had today, I find it hard to believe that this earnings is going to wipe us out. It's possible if the market doesn't like the forward guidance, but oh, Boeing's likely having some problems. Not yet, but I just seen this reports of in-flight excessive temperatures. That can't be good. I haven't liked Boeing since they killed all those families of people. Just can't see how that stock is ever going to be good again. I don't even like flying now because of Boeing. So we'll see how it goes. On Friday, I guess we will be prepared for what comes next. Since this is what's holding up a lot of those trades, we should be clearly rotating back into growth by Friday. This was the last hangup, so it should be resolved. And if it is, then by Friday, we should be able to hunt down some software plays or, some kind of growth plays. We can short value and get long growth if this plays out. Otherwise, we'll just continue to do what we've been doing, which is stay long in value and continue to short growth. That's what I got for you guys. Unless there's any questions, let's just wrap it up and we'll see everybody at the morning briefing. Which, by the way, if you're not attending the morning briefing, you should do that. If it's too early, catch the replay. I record them and I keep them on YouTube. So even if it's a little late in the morning, it should still give you context throughout the day. I'll get this meeting up onto YouTube, and hopefully Friday we'll start with the stream in Zoom and on YouTube live at the same time. All right, everybody. Let's see you in the morning.